We're news for business people.
Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah, and today on the show we will discuss the common mistakes that investors make while investing in mutual funds. I want to start off with a set of charts which are not really mutual funds but stock charts, but they in a manner of speaking amplify the kind of mistakes that investors would generally make. So these are a set of 3 stocks that I've chosen, and let's start off with the pink line at the top, which is the stock price of Maruti Suzuki. Now, a lot of people who would have invested into Maruti Suzuki at the start of this period, which is a 10-year period, and after the stock would have reached particular levels, they would have thought that, hey, I've made my 15, 20, 25, 30, 40%. They were not thinking the long term, and they got out of the stock. And the chart then tells you what happened to the stock and what would have happened to the returns if you had stayed invested in the stock of Maruti Suzuki. So investors tend to make this mistake at times of not thinking about the long term. Now, a lot of people who think about the long term don't monitor their investments, and therefore the second stock that I have on the chart, which is the turquoise blue line, speaks about how if you don't monitor a long-term investment, then you may well reach a peak and then come off and you'll be left holding the bag. So it's very important to probably monitor those investments as well. The third chart is of a stock which over a 10-year period or maybe over a 19-year period has given returns less than 10%. And that shows that it's important to do adequate research before making your investment decision, because you may get into a blue chip investment, but it will not do what it is supposed to do, and that is give you returns. And that's why investing would be a combination of a lot of factors. Similarly, mutual fund investing would be a combination of a lot of factors and of avoiding key mistakes. So we thought it best to get in 3 expert minds who advise people day in, day out about things that they should do, more importantly, things that they should not do. And our 3 experts are with us: Tarun Birani, founder and CEO of TBNG Capital Advisors; CA Harsh Roongta, he's an independent investment advisor; and Shalini Dhawan, director and co-founder, Plan Ahead Wealth Advisors. All 3 of you, thank you so much for taking the time out and joining us. Mr. Roongta, let me start off with you. And amongst the mistakes that we've collected from the 3 of you, the first one, I'm starting off with one mistake that you believe people usually make, and which is they deviate from goal-based investing. Now, can you explain why? One, what would you mean by that? 2, why would this happen?
So, people think that investment is an end by itself. Ultimately, you invest to achieve something. And I think, there is a saying that if you don't know where to go, any road will take you there. So you better know where you want to go. Most of the goals for people are marathons, right? I mean, they're really going to need the money for their retirement, maybe 10, 15, 20 years from now, maybe for their children's education, for other goals that might be 5 years, 7 years, 10 years. These are marathons. You can't run a marathon like a sprint. So people, when they concentrate on scripts, for example, mutual fund, and now they're doing the same with mutual fund schemes, which is the best scheme, you know. And I think the key is, if you know what you want to do, that helps you in choosing the right scheme. So for something that, say, you want to do a year, 2 years down the line, no matter how much of a risk-taking investor you are, you would not really be well advised to take any equity at all, whether equity scripts or equity mutual funds. For something that's more medium term, I mean 3 years to 7, 8 years, maybe you can take a bit of equity, that bit depending on your risk-taking ability. If you're higher risk taker, maybe you can go for more aggressive balanced funds.
Sure.
If you're a lower risk taker, maybe you can go in for what are now called equity saving funds, etc. For something longer than 8 or 10 years, you can definitely look at equity, pure equity as well. But again, if you're a low risk taker, you can have balanced funds. So my point is, unless you know what you want to invest for, you're likely to make a mistake.
And people do that. People deviate from goal-based investing.
Most people mistake. I mean, how well you run in the first 100 meters in a marathon isn't really going to matter, because you have to finish the marathon. I think people forget that.
Yeah, well, that's interesting. And Tarun, I think a shade of similar to this mistake that people might be making is also that midway through achieving that goal, people alter the financial plan as well. Is that what you're trying to say when you're talking about altering your financial plan?
Yes. So the point first I wanted to make was there is no financial plan, first of all, for most of the people.
Okay.
It's always like random investing. So people don't know what they want to do. And there is a lot of herd mentality which always creeps in, wherein today equity is doing well, let's jump into it. Today real estate is doing well. So like that, your friends, relatives and all those make you feel like you are missing out something. So that makes you take all those decisions. So there is no financial plan in place. What Harsh made a right point was the purpose part was always missing. So defining that purpose is the most important part, and once you have defined those purpose, I think all these mistakes could have been easily solved in terms of getting out, getting in. On all those troubles can be easily achieved if the purpose was more clearer. So, and I have seen even people who have defined those purpose and who are not very convinced about that purpose, they tend to alter it in between. What they do is, let's say markets are fallen by, let's say 30%, a 2008 kind of classic situation where the markets were down by 40–50%. At that time, if you don't have a clear-cut direction or a purpose in mind, I think the most perceived risk was so high at that point of time that people tend to exit the markets at that time. But people who know, I need this money for my kids after 15 years, 10 years. So why do I need to put more money, right?
Yeah.
The actual time to...
So are you guys saying that if indeed people approach a mutual fund investing, whether now or a year ago or a year later, should actually invest in a scheme or 2 schemes or 3 schemes with an end goal in mind, that I may want to buy a car, I may want to pay for my education, I may want to plan for a holiday that I want to do, or retirement?
Absolutely.
And therefore don't deviate from that path.
Absolutely. So the path is never absolute. I mean, it's like a journey, right? You plan your journey, right? If roadblocks come up, you may have to deviate. But the point is, you decide even about those deviations early on. That if I see a roadblock, this is what I would do, right? So those are the things that you do. And when you do goal-based, when you know where you want to go, you avoid the kind of, I mean, for example, if you know where you want to go, you will not even think about Bitcoin. What does it matter if I lose out on Bitcoin? It doesn't matter. Is it helping me meet my son's education needs, meets my retirement need? If the answer is no, Why would I consider Bitcoin?
Interesting. Well, yeah, I know the bulls on Bitcoin might say that, hey, maybe if you invested in Bitcoin, you would reach there faster. But yeah, I think viewers get the point that our advisors are trying to make. If you have that goal in mind, and if you know that your set of investing that you've embarked upon would help you reach there, then other things moving around that process will not really deter you from that path. Now, there is one very interesting set of mistakes that Shalini's pointed out, and the first one I thought was fairly interesting. Shalini, you were saying that people are forgetting, or people at times forget, the importance of asset allocation. So one is to set up a goal and try and reach there and stay there.
Right.
But two is, even when you've set up that goal, it is very important to have a right mix of assets that you have in your plan, be it mutual funds, be it various categories of mutual funds, or be it have equity, debt, and non-equity linked and gold linked as well. I think people don't do that, you're saying.
Yeah, so what actually happens is, and this is, you know, I'm taking from examples where we've done goal-based investing as well, is that, you know, if we have thought of, you know, let's say a 50-50 mix, okay, and let's say today's market scenario, the way it has, obviously the 50 rupees that you have in equity has run up. Now, what does the whole concept of asset allocation say? It basically says that if your 50 has run up, you hive off that amount. If 50 is gone to 60, you take off your 10 rupees and move into a fairer valued asset. So what that technically allows an investor to do is it basically allows the investor to actually sell at a high. So this actually allows the investor to do or guide the investor to something that the investor psychology doesn't allow. So what investor psychology does is that investor psychology says that, oh, I must remain invested in equities because, you know, it's gone so high. So what happens is, as greed is where, as an investor, it takes over me, and it says that I have to forget that 50-50 and I just have to go and, you know, keep riding this wave. So that's where somewhere, you know, like you gave the example of the stock which went up, I think it was JPA, went up and then kind of, you know, that's where the asset mix comes into play. That if it had gone up, there was a certain time when you needed to exit it. So there's a pointer at what time should you exit. Many investors ask that what time should you exit at. I think a good time to exit would be when your asset mix has to be rebalanced. So that gives you a pointer on when to exit also.
Yeah, and which is where I think the importance of having a sound financial planner also comes into play. Right. Mutual fund investing is not as easy as one would make it out to be. But Tarun, I think the point that Shalini is making ties in with, again, your first point too, right? Altering your financial plan. If you've entered into a financial plan which has a healthy mix of equity and debt, and if people midway go through it and alter it because they think that, oh, equities is doing so well. So even though their plan had foreseen that if they have this judicious mix of equity plus debt and it will help them reach the goal, and by virtue of seeing equities do well or equities not do well, if they deviate from their plan, it might actually end up them not being able to meet the goal.
Right, right. So this planning exercise, what you just mentioned, it's all about planning, execution and review. It's a continuous review which always keep happening. Yeah, and I think in your human life, I think there are a lot of changes which keep happening. You get married, child coming in your life. After that, let's say you're retiring. All those are different stages. Your asset allocation mix keeps changing, right? Psychologically, your risk tolerance level keeps changing all these times. Yeah. So it's very important to understand those risk profiling at various intervals and make sure your portfolio is aligned with that, so that you don't get into all these traps of market all the time. Yeah. So if you have defined 70-30, so you'll make sure come what may, 70-30, even if the market makes your portfolio become 80-85, just come down to 70% level. So what Shalini just made a point, I had a case last week only where one of our investor is invested with us almost for 7 years now, and so his asset allocation mix, he's almost 50-51. His asset allocation moved to 75-80% level right now. So defined level based on his risk tolerance, goals and all that, we have defined a wall of 70%. But it was so difficult for us to convince him to move from 75-80% to 70% level. He felt that market is going to do well. What is the need to do that right now? We can if I would have told him to put more money in equity, he would have easily done it right now.
Got it.
So I had to use a whole host of lot of analytics to make him convinced that, boss, this is not the right way to look at it. Your age, all those things demand that you need to be at 70% level. And finally, he taken that call. But I think investors tend to, in the current euphoria of the market, they will very difficult to convince them.
So judicious. Sorry.
I've seen reverse happening as well. you have clients who are so fearful, oh, the market is so high. Okay, I just want to book profits. Okay, so I said, ma'am, please look at your portfolio. Okay, given your age and your risk profile, yes, your allocation has moved up from 23% to 30%. Okay, but even if you book profits, okay, it will go back to 25%, right? I mean, and you built it up systematically, you're continuing to build it up systematically, your goal is a long way away, even if the market falls, right? So, reverse of this, then it applies both ways.
It applies both ways.
It applies both ways. That's what I meant by planning.
Right.
That you need to plan for this in advance. So, profit taking, as Shalini says, which is basically asset reallocation, okay, rebalancing, it should be part of a plan. If it is part of the plan, as they had put a wall of 70%, it should kick in automatically.
Sure.
Okay, there should not be emotion involved with it, and I think a planner helps you get over that emotion.
It does.
That is the real value that the planner brings.
Yeah, so don't forget the importance of asset allocation as well, even as much as you should stick to the plan that you have. However, so these are a first set of 3 mistakes that our experts have. There is another set too. But before that, we also thought that we spoke to a bunch of other people too, aside of our 3 experts here. And we found out some other common mistakes that investors make while investing in mutual funds. A lot of these have an overlap too. But Jayesh sums up all of the other key details or other key mistakes that we found out from other investors. Jayesh?
So Neeraj, aside of what you have already discussed, some of the feedback that I got from the people I spoke to is that they said that, you know, not many people know what the securities are owned by the fund. So, you know, essentially very important to know what the fund is getting into, whether it's a particular sector that they are more tilted towards, or, you know, a stock allocation that they have done, or even, you know, sitting on the cash level. So that could determine a lot of factors or give you a lot of indication as to what the fund is intending towards. The other factor that needs to be considered is that, you know, not many people read the scheme of a document when it is released. So it essentially gives you a lot of information of the underlying you know, the securities, the management that is going to take care of the fund, or, you know, what kind of expense ratio or the sales load that is going to be added to the scheme. So, you know, scheme information document gives you a lot of information about the scheme that you are getting into. The third mistake is, and of course we've done a full show on this on the mutual fund show, saying that hunting for low NAVs may not be the right strategy. So, you know, stocks like Maruti have done exceedingly well and touched 5-digit, and so have mutual funds wherein the NAV as high as 4 digits. So those two have also done well. So need not that only low NAV funds will do better going forward. Last and final mistake to avoid is that a lot of people get into the dividend option when the purpose is to solve a long-term goal, like the guests are talking about. So, you know, when you have a long-term goal, always invest in the growth option instead of the dividend option. And we have seen how the power of compounding actually takes place in this particular case in one of the shows that we did earlier.
Yeah, that's interesting, Jayesh. Thanks a lot for putting those into perspective. Keep in mind, viewers, the point number 1 and point number 2 that Jayesh mentioned are essentially, if you are a nuanced mutual fund investor who knows how to pick mutual funds and therefore are going out on your own to pick up those schemes, and therefore and out there you'll probably look at all of those things, and which is where point number 1, point number 2 come in, because people tend to make those mistakes while choosing funds on their own. If you indeed have, this is mistake number 1, not knowing the portfolio of securities owned by the fund. Frankly, if you are leaving it to your financial advisor, then the advisor will know what fund is good for you. But it's only when you're going out on your own that you need to probably also look at a point like this, the portfolio of securities owned by the fund, and point number 2, which is reading the scheme information document. Frankly, leave it to the advisor, and maybe he will anyways do the needful, so you don't need to go through that process as well. There are a couple of others too, but before I get into those, let me ask the second set of mistakes that set of investors want to do. By the way, either of you want to comment on the 2 or 3 things that Jayesh brought about. I thought the hunt for low NAV funds was something that I guess everybody tends to do, right? Any of you wants to make a point on that?
Right. So
actually, on the dividend point, I mean, a huge amount of missell is today happening. I think the only missell that is today happening in mutual funds are balanced funds with dividend option. I have had the very unique experience of being scoffed at by a senior citizen that, I'm ignorant about mutual funds because I told him that taking a balanced fund with dividend option, you're being conned. Okay, and he actually scoffed at me. I think this is a very dangerous thing that is happening because the expectations that are being built. The danger is that those funds are not bad.
Yeah.
But now they have added 150% to their corpus over the last 1 year, 1.5 years, based on this promise of implicit continuity of dividend.
Yeah.
First of all, as Jay has already pointed out, dividend in a mutual fund is meaningless, right? Especially if you have no use for the dividend. If it's a long-term investment, what will you do with the dividend, right? It's your own money coming to you. Plus, it cannot be guaranteed. It can only be declared out of realized profits in the fund. And as the corpus grows, the realized profit as a percentage of the corpus is going to drop.
Yeah.
Okay. Second, much more important is to keep that dividend going, they will have to keep selling the stock because only when the profit is realized can a dividend be declared. And that hurts not just the people who have chosen the dividend option. It hurts even the people who have chosen the growth option because when they sell those shares, they will have to sell it across all schemes.
True.
So I would stay away from funds, stay away from balanced funds that are pushing dividend options so aggressively. It is an extremely dangerous trend. It is going to come home to roost when the markets fall, if the markets fall.
Yeah, at some point of time, I think we'll probably tell our viewers about some of these funds that should be avoided as well, but that's for another day. Quite frankly, there are a lot of other options, but I think this is a very, very pertinent point. The promises of returns for perpetuity that are being promised to investors, it's a dangerous trend as well because it could well turn away a lot of investors who are starting to come or have just about come into the equity markets and mutual fund route over the last couple of years. Anyways, more on that later. This other set of mistakes that I wanted you guys to highlight, and mistake number 2, and Shalini, I'll start off with you. Yeah. Chasing short-term returns, and this is something that you believe investors tend to fall for.
Yeah, so what happens is, as an investor, we read so much, so much comes into the headlines in terms of the way the markets are going, or if it was real estate at one point in time. And as an investor, we fall for this concept of missing the bus, and therefore we are like, oh, have we, and we hear family and friends talking about the gains that they've made in such short spans of time. We tend to make 2 mistakes. One is we tend to fall for that, what has happened in the recent past will happen in the future for me when I get in. And the other thing is we tend to in fact take monies which are for shorter term needs, maybe 1, 2, 3 years, and we allocate them to this kind of an asset, which may be a very risky bet for an investor, because what has happened in the past in performance may not be repeated. One. Second thing is that the return may not be repeated, but you are embracing the risk of that asset class without understanding much about it. So like the first and the second mistake that Jayesh pointed out about also, knowing the portfolio of securities or knowing the scheme information, scheme document, it's important to know what mutual fund, what scheme is your friend or family talking about. And if you're getting into that, just looking at the last 6 months or 1 year performance and not really looking at the track record of the scheme, or not really looking at how it's done over 3, 5, 10 odd years, you're getting into something where the risk is imminent, the return is for anybody to guess. So that's where the folly lies.
Okay, and Mr. Roongta, part 2 of that is, and also ties in with the point that you're making, don't chase winners. My question to both of you would be that here's an investor who, let's say, doesn't want or doesn't have a financial planner. How does he or she choose the fund? Because he's looking at, let's say, a website which is marking the funds with 4 star, 5 stars based on the past performance, based on the recent performance, so on and so forth. And he would want to choose a winner. He would want to choose a fund which has given great returns. And here is my panel of experts saying that don't chase winners. What does he or she do then?
So please remember, as I said, as they say, every year the winner is going to be different.
Yeah.
Okay.
So how does one choose then?
So the point to choose is that in a marathon, right? If you see a marathon, there is a bunch of runners, right? At the beginning, there will be another bunch which will be maybe 100 meters behind, right? As long as when you start out with, you choose somebody who's in the first bunch. He may be third, fourth, it does not matter. The difference between them is 5 meters or 10 meters. It's a bunch, right? And please remember, the bunches are going to, the people who are in the first bunch may fall back to the second bunch. The people who are in the second bunch may progress to the first bunch. You're still running a marathon. You're betting at the end of the marathon. You're not really worried whether at the end of 100 meters is the guy still first. That is the mistake. So choose a winner. I think anyone in quartile 1 is a winner. And as long as he doesn't fall to quartile 3, I would continue to bet on him even if he falls to quartile 2. There is data points that show that if over a 10-year period, if I started with a good fund, which was in quartile 1, stuck to it over 10 years, right? Instead of every year going by last year's winner, in the end I made more money.
Okay, and that's interesting, but keep in mind that this need not mean that you have to necessarily stick to this, but it's a good indication. And if you monitor your funds cautiously and carefully, you might be able to make those decisions as well. Tarun, you wanted to make a point here?
I wanted to make a point what Harsh just mentioned, that if you do a 10-year or a 15-year study of the top funds, or let's say first 30 funds, the CAGR return difference is almost 2%, 2.5%, like that. I have seen people spend a lot of time in this activity of 1-2%, whereas if they look at what kind of asset allocation they have done to this asset class, is hardly 5, 10, 20% of their asset class. And their 80% is lying in a real estate which is generating zero return to them.
Sure.
Yeah. So I think we tend to spend a lot of time on performance rather than on asset allocation. If that is done and a review exercise is done correctly, I don't think you'll end up, the wealth creation will happen for you.
I think which is what Shalini's first point was, forgetting the importance of asset allocation. Okay, I have time for that mistake number 2 from Tarun before I move on to maybe some advice on funds as well. But Tarun, I think an important point, because one fund house told me as well that this was, according to them, one of the biggest mistakes, and that is over diversification.
Yeah. So mutual fund in itself is a product of diversification. In a scheme, there are more than 50-60 stocks lying, right? In that also, I have seen portfolio of clients who has 30-25 mutual fund schemes in their portfolio. So when we do that study, we realize that this over diversification is actually killing the performance of the portfolio. I think performance comes with conviction. So you need to have a strong conviction on something. So I feel one large cap fund, one multi cap fund, or one mid cap fund in a portfolio, if taken and reviewed over a regular period of time, it is a good exercise rather than having 3-3-5-5 fund of each category and end up having a flavor of everything. So try to build up a concentrated portfolio in each category. That is going to give a better performance.
And you would say this irrespective of the size of the portfolio. मेरे 5 लाख रुपए हैं तो भी 3 या 4 फंड. अगर मेरे 1 करोड़ रुपए हैं तो भी 3 या 4 फंड.
I believe so.
Okay, fair call. We have last couple of minutes on the show. Instead of giving out a bunch of recommendations, let's just make it simple. We'll discuss ELSS schemes maybe in a couple of shows later. But if I were to request our experts to for the sake of somebody who's wanting to invest afresh in mutual funds, if there is a scheme or a set of schemes that you believe are good enough to go in. This is not a comprehensive list by any means. It's probably 1 or 2 examples that you believe could do well. Shalini, if I can start with you.
So, we were discussing, there was an investor who was looking at investing for a 10 or 15-year horizon.
Oh yes, we have a question like that, by the way.
So I think the Aditya Birla Frontline Equity Fund is one such example. It's actually got a 15-year track record, if I'm not mistaken. and it's one of those funds who's consistently shown good performance. Like you know, Harsh mentioned that it's one of those group
top
of
quartile,
top quartile. So I think that would be my one of my bets.
Okay, remember it's just one of our bets. She's got other bets too, but this is one example. And similarly, one of the many examples, but Harsh, if I can ask you to name one out of the many that you probably have.
I mean, again, the point, the way I would answer, if you want to invest for 15 years, where should you invest? Please invest in an equity mutual fund.
Okay.
And if you can't make up your mind, please invest in an index equity mutual fund with the lowest possible expense ratio, if you can't make up your mind.
Okay.
If you want to invest in an ELSS, for example, and to the extent you need a tax break, you invest in an ELSS. I think it is it's a discount given by the government of India for you to invest in equity, okay, to build your wealth. Which one would I prefer? I would say Aditya Birla Sun Life tax relief, but I mean, please put it in an ELSS. There are several other good ELSS as well.
This was just one example, as we
Absolutely.
said. Tarun, one example, not many.
So we like this Mirai India Opportunities Fund. It is one of the consistent schemes. So this can be looked at. Yeah.
Okay, again, from a long-term perspective.
Yes, long-term perspective.
Okay, great. And here we are discussing long-term investing. If you really want to do a 6-month, 12-month investment bet, then please consult a financial advisor. Really, this is from a perspective of somebody who wants to, you know, the Hero Honda ad, fill it, shut it, and forget it. If you want to invest for the long term, some of these are examples that you could look at. But more on this issue over the course of the next few shows as well. For today, I think we've come to the end of the time on the show. So Tarun, Harsh, Shalini, thank you so much for taking the time out and being with us on a day wherein reaching offices was difficult, but thanks so much for joining in today. And viewers, thanks for tuning in to the Mutual Fund Show.